I started the recording. Abhi start hogi. Yeah, great. So, should I come straight to question 5?
Yes, we can do that. Uh, all right, so class, okay, Nitesh and Sharon are here. All right. So guys, ma'am is indisposed today, so we'll be taking the class. In the last class, we covered up till question number 3. Question number 4 is similar to what we have covered before. So we'll jump directly to the question number 5. Okay. I have a bit of a network problem, so I'm keeping my camera off. If there is any issue, then please let me know. Samriti ma'am, can you please share the screen? Yeah.
Yeah. Just a minute. Is it
Yeah, we,
visible to everyone?
yes, it's
Yeah,
visible.
it's visible.
Yeah.
Okay.
Okay. So let's keep the
It
class
just
a
a
bit
minute.
conversation, Wali, so that you guys are able to understand more. Okay. All right. Okay. So this is an example of cash burn and cash bill. So following are the 2 years of income statements and balance sheets of the Munish Export Corporation. So we have given the cash and accounts receivable and inventories and all the basically current assets and your fixed assets. Then we have been given your bank loans and your long-term debts, which is your liabilities, and your capital, which is the part of the capital. Okay. Then income statement is given, which will give us like net profit. That is your incomes minus expenses, and then your net income and or losses is given. So let's start with the first question, which is calculate the cash built, cash burn, and net cash burn or built for Munish Export in 2016. Should I read all the questions first and then go to the answers? Is that a better approach, or should we go one by one? Nitesh, Sharon?
Ma'am, I guess if we could go one by one, that would be better.
Perfect. Okay. So in part A, we have to calculate the net cash burn and net cash built. So tell me something. What is the formula for cash burn? Samriddhi ma'am, can you just shift to the answers? Okay, how will you calculate the cash built? Do you guys remember the formula that is required?
I think it's net sales minus the difference in receivables.
Okay, great. Let's just come for the part A. So this is the given information that we have in the question. Okay, and the things that will be required to solve the numerical. So let's go to part A. Ma'am, can you come down to the part A? Yeah, thank you. Okay, so the formula for cash burn is that we'll have to add all the operating expenses, interest expenses, and tax expenses. In that, we will add the increase in inventories. Okay, and from that, we will decrease the changes in payable and accrued liabilities, which is your current liabilities, plus your capital expenditure. Capital expenditure is something like this, purchase of long-term assets or something. So if we come back to the information which is given to us in the question, ma'am, can you scroll down? Can you scroll back? Yeah,
This part, right?
yeah, can see. So the total operating expenses is of 1,27,000. Okay, this is not 1,27,000. This is 12,70,000. Then interest expenses are of 55,000 and tax expenses are of 88,000. In this, we will add the increase in payables, which was calculated for at 50,000 minus I think increase in accruals, right?
We will add increase in inventories. It's not mentioned in the
Oh,
given information. And the increase in
minus.
payable and
Yeah.
the increase in payables and accrued liabilities will be deducted. So, do you want to carry forward, Harshita?
Yeah, I can no issue. So the capital expenditure, how will you find it out? If you can see in the given information, you can find the expenses that we have incurred for fixed assets. See that addition in gross fixed assets. Is there any like okay? Why are we treating assets as capital expenditure? Is this because do you guys know the difference between revenue expenditure and capital expenditure? Nitesh, Sharon, Porika. All right, let's just carry forward. So we'll add the capital expenditure. D, can you just scroll down? Fine. So we'll get a cash burn of 15,98,000. In the same way, we'll go with the cash build, which is net sales minus increase in receivables, which will come at 15 lakhs. The net cash burn will be at the difference between cash burn and cash build. Moving on to the part B, we have to calculate the monthly cash burn rate. So for that, the net cash burn that we calculated in part A, we'll just simply divide it by 12. Further, if we want to know what is the monthly remaining out of cash, to do that, we have to first find out what is the year-end cash balance, which I think was 50,000 if you look in the balance sheet. And we will divide it by the monthly cash burn rate. And that will give us the monthly remaining out of cash, that the months remaining until the business is out of cash. Is there any problem, any doubt in this numerical? Nitesh, Porika, Sharon?
Actually, I stopped attending classes for a while, so I have little bit difficulty in understanding this. I may be familiar with later in this week.
Okay, okay, no problem. So just try to understand the numericals. They are very simple ones. And if you have any doubt or if you cannot understand any term, please just ping us. Okay.
Thank you.
All right. So let's move on to the next numerical. I think it's numerical number 6. Question number 6. Yeah. So question number 6 is again similar to what we have just covered in question number 5. Please give it an attempt. Let's go on to question number 7. All right. So
Is it clearly visible?
yes, ma'am, it's visible to me. Class, please
I
let
think
us
so. I
know
will
if
need.
any question is not visible to you. All right, so use the financial statements data for Castillo products provided in problem number 6 and calculate the net profit margin 2015 and 2016 and the sales to total assets ratio using year-end data for each of the 2 years. All right, so if we just see the question number 6, the data that is available there. So first we have to calculate the net profit margin ratio, right? So anyone can tell me the formula for net profit margin ratio? Porika, Sharon, Abhinav, Hitesh. Anyone who can
The
remember that formula? Yeah.
net profit by sales revenue.
Yeah, perfect, perfect. Net profit divided by net sales. Great. So that's how we'll calculate the net profit margin ratio. For 2015, it will be $65,000 divided by $900,000. My screen is a bit hazy, so let me know if I'm reading wrong figures. Okay. Then there is, yeah. So and for 2016, it's $75,000 divided by 15,000. No, 15
It's
lakh, 15
1.5.
lakh, yeah,
Yeah,
1.5
15
lakh,
lakhs.
yeah, 15 lakh thousand, right? 15 lakh dollars, yeah. So that's it. That is how we'll calculate the net profit margin ratio. And then we are asked to calculate sales to asset ratio, right?
Sales to total asset ratio, right?
Sales to total asset ratio. Again, what is the formula for this okay, for this ratio? Anyone who can remember it? Sharon?
Is it the net sales upon the average total assets?
Perfect. So it's very easy to remember such formulas if they are asking you to like if they are asking to calculate sales to total assets. In the name itself, the formula is given, so you don't need to think about it much. If we can just come to the solutions, I'll show you the calculations. Perfect. Okay.
Yeah.
Ma'am, you need to scroll down to question 7, right? Okay, so that's how we calculated the net profit margin for 2016 and similarly for 2015. Sales to total asset ratio, again, net sales divided by total assets, we can calculate it again. Similarly for 2015 and 2016. Now in part B, they're asking to calculate return on total assets. The formula for that is net profit divided by total assets. If you can see in the numerical that we have provided, the solution that we have provided, we are taking net profit divided by net sales ratio and net sales divided by total assets ratio. Net sales will cancel out. So the formula will come at net profit divided by total assets. Since we already had calculated these two ratios in the previous part, we directly calculated this return on assets ratio. We can calculate it for 2016 and 2015. Any doubt in how we are calculating this? Anybody? Is there any doubt? Okay, let's just move on. Can you come back to the question, ma'am? Let's just read the question first. Thank you. Okay, so in part B, we have calculated the ROA. That's okay. So in part C, okay, we are going, yeah. So calculate the percentage growth in the net sales from 2015 to 2016. Compute this with the percentage, compare this with the percentage change in total assets for the same period. How will you calculate the percentage growth in net sales from 2015 to 2016? Anybody? Naman? It's a simple mathematical question. Hitesh? Abhinav? Sharon, would you like to take the initiative?
I mean, the net sales have been given in the income
You have
statements
to,
and things, right?
yeah, you have to calculate the percentage growth, percentage change, na?
Right.
It's a simple mathematical formula. See, it's nothing. It's just like new minus old divided by the old. So the sales of 2016 minus sales of 2015 divided by sales of 2015. Similarly, we will calculate the change in total assets for the periods. Let's go on to part D, which is express cash expense item as a percentage of net sales for both 2015 and 2016. Describe what happened that allowed Castillo products to move on from a loss to profit between the 2 years. Okay. Let's go back to the solutions. See, we are calculating the percentage growth in sales. Again, the sales for 2016 minus 2015 divided by 2015. Similarly for total assets. Ma'am, can we move down? Yeah. So now they have asked us to express all the expenses in terms of sales. You don't have to do anything, but just take all the expenses and divide them by the net sales. Is there any problem in this D part? Sharon?
No, ma'am, it's clear.
Clear? Great. Okay, so interestingly, they asked that how can the company move from a loss incurring company to a profit making company in just the span of like 1 year from 2015 to 2016. How did it started earning profits? Can you just can any of you let me know how was that possible? What happened in this duration of 1 year that they were able to earn profits instead of incurring losses? Hitesh, Abhinav, Nitesh. Okay, so it's very simple. If you notice, the sales value increased a lot. They increased their total assets, and that lead to the exponential increase in sales. And when your sales is increasing, of course, your profit will increase, because your like your cost of goods sold, that didn't increase much. It was stable at 60% only. And the other expenses also, they were also maintained at the same level. Is that clear? Any doubt anyone have in this numerical? Okay, let's move on to the other one. So let's move on to question number 8. All right. Okay, so question number 8 is again similar to what we have covered till now. So please attempt this question. Let's move on to the question number 9. Okay, so we have
Is
to
it
calculate
visible?
profitability ratios. Yeah, this is visible now. Okay, make use of the financial statement data provided in problem 8 for safety first incorporation. Calculate the operating profit margins and the no PAT margins in 2015 and 2016 for safety first incorporation. What changes occurred? Okay, let me read the questions so that we can jump to the answers straight away. So calculate the operating returns on assets or the ventures basic earning power using year-end balances, balance sheet information for the both 2015 and 2016. Describe what happened in terms of operating return performance. Okay, did the venture benefit from using interest bearing debt in the form of bank loans and long-term debt in 2015 and 2016? All right, so can anyone tell me the formula for operating profit? And net and no PAT margin also, that is net operating profit also. Anyone? Abhinav, Porika, Nitesh, Sharon.
So the operating profit margin would be the earnings before interest and taxes upon the net sales. And I think NOPAT would be net income by net sales.
Okay, great. Let's come to the solutions. Fine. So this is the okay. Let's just go to the question number 9 first. Yeah, this is the information that is given to us in the questions. And again, like EBIT by net sales, you defined it correct, Sharon. So how can you calculate it? Just like deduct operating expenses from from gross profits, and you will be left with operating profits. Then divided by net sales, you'll get that percentage. Similarly, we can calculate in 2015. Moving on to the next part, no PAT margins. Again, we can calculate it by EBIT 1 minus tax rate. Acha, how will you calculate the tax rate now? Because you are given the tax amount. So how will you calculate it? Ma'am, can you just go back to the information that is given to us? Yeah. Okay, so now see, okay, where is the tax? Okay, come to the income statement. You guys can see the tax amount, that is 250 for 2015 and 300 for 2016. Is it visible?
Yes, ma'am, it's visible.
Okay, so you just need to divide like 300 by 900 and you'll get the tax rate. Since 2016 is the current year, we'll use that tax rate and not that of the 2015 one. Okay. Ma'am, can you please come to the solution part? Yeah. Okay, so like this is the rate that we'll calculate for 2016. Similarly, we can do it for 2015 one. And for the no PAT margins, just include this tax rate in the formula and we can calculate it. As you can see, there have been a decline in the profitability from 2015 to 2016. Okay, so then they asked for operating ROA. The formula is again EBIT divided by total assets. EBIT we have just calculated, so you can just divide the total assets like figure and calculate it again. Okay, so in the third part, they asked whether taking more debt was beneficial for the company or not. So understand this, that when a company is taking a debt, it is important for them to for the like lenders to know whether the company can repay the debt or not, and the interest payment as well. So we are calculating the interest coverage ratio for the same. Interest coverage ratio is like this, that whether the like day-to-day earnings of the firm is enough to compensate for the interest expense that will be borne by the firm or not. So the formula for that, the same is EBIT divided by interest. You can calculate it for the both years. And I think we have covered the numericals, right? Is there any doubt anywhere that you don't understand anyone?
Ma'am, can you explain the significance of the interest coverage ratio?
Okay, see, so supposedly I have a company, okay, and you are a lender, a private lender, and I came to you and I asked, okay, I need supposedly 100 crore rupees for our project, and will you fund me or not? How will you judge whether I am the right person to fund or not? How will you judge? First, you will have to see now whether my earnings, my year-end earnings, are enough to cover your interest payments. Supposedly, if I'm saying, okay, I need like 100 crore rupees at 10% interest. So, firstly, you will see that whether I can cover that 10% interest payment or not. So, naturally, my income, my year-end income should be much greater than the interest payment that is due to you. If I am supposedly owing you like 10 lakhs rupees, if I'm owing that amount to you and my year end profits are supposedly 20 lakh or maybe just 15 lakh, you will be in doubt because you will say, yaar, how will I cover your interest payment properly? And if my year end income is only 8 lakhs, then you will definitely not give me loan because I can't even cover your basic interest payment. So if this coverage, like interest coverage ratio is higher, it is good for the lenders. As high as it will be, the lenders will be more like willing to give you the loan because they know that you'll be able to cover the interest payment. After that, as a lender, you will see that whether I can give the principal amount back to you or not. For that, you will look at my debt equity ratio and my like the others ratio that you will look for that to check my like my long term standing of the company and the risk factor of the company. But for interest coverage ratio, you will look at the liquidity, my liquidity position, how sound I am, so that I can pay it back to you. Is it clear now, Sharon?
Yes, ma'am, it's clear. Thank you.
Great, perfect. Okay, so I think we are through with the numericals. Is there any doubt anywhere that anybody had? Okay, so I think we can move on with the topic. Okay, so we'll be starting a new topic today. I think it's I think types of financial costs.
Yeah. Okay. So ma'am had uploaded uh, additional notes on break-even analysis from her management accounting course. So you can also go through it for your additional learning. Of course, it has been tested in the previous minor, so it won't be tested now. But for your additional learning, you can go through this material and it explains the concepts much more in detail. Now we can move on to the types and cost of financial capital.
Great. Perfect. All right. So let's start. Like, what is public financial markets? So the markets are created for in which we can trade the in which we can trade and sell the securities, and they have like standardized features. They are regulated by proper authorities. So if the market is of such nature, it is like public financial markets. Similarly, we have private financial markets, which are defined as the liquid securities markets, which are less standardized. And
Should I move forward? Hello?
am I
Hello?
am I audible? Ma'am, am I audible?
Yes, you
Did
are.
I lost the connection in between?
I think so you lost your connection.
Okay, okay, fine. Okay, so let's move forward. So interest rate, it is that price which is paid to the borrower fund. So supposedly if I'm taking a loan of 10 lakh and it's of 10% interest, then that 10% will be my interest rate. Moving forward, we have default risk, which is the risk that a borrower will not pay the interest and or on principal on a loan amount. Okay, so in this PPT, we have a lot of definitions which I'll be covering. If anywhere you guys have any problem in understanding any concept, please interrupt in between. So moving forward, nominal interest rate is the stated interest rate that is given in the documents. Moving forward, real interest rate. So the interest rate which we consider after eradicating the impact of inflation or risk or illiquidity, that is the real interest rate, which is the actual cost which is borne by the borrower. Risk-free interest rate, basically it's that interest rate which we are assured of that this much interest rate we will receive. Like in FD, in India, I think currently it's around 6%. So you know that 6% of the interest rate you will definitely receive. That money will not be, it will not sunk basically. So interest rate on that is virtually free of any default risk. That is your risk-free interest rate. Example is your FD, like I just said. So inflation, it's that the rising prices not offset by increasing quality of the goods or services being purchased. That is our inflation, which impacts our which impacts our interest rates. And after we add the effects of inflation and everything and the risk factor in risk-free interest rate, we reach the nominal interest rate that is that is borne by the borrower. Okay, what is the inflation premium? So it is the average expected inflation rate over the life of a risk-free loan. If there is any doubt in between, please interrupt in between, because there are lots of definitions that I'll be covering right now. Okay, so move on. So default risk premium, it's like that the additional interest rate premium required to compensate the lender for the probability that a borrower will default on the loan. So supposedly, if I have taken loan from Sharon and she is uncertain whether I will repay that loan or not, so she will charge a little bit extra interest rate from me. That little bit extra interest rate that will come as default risk premium to assure that I will not default on the loan payment. Moving forward, prime rate. So sometimes like there are customers to a bank which are very valuable to them. Maybe they have a very large bank account with them, or they have like in the transactions in crores and crores with the bank. So the banks offer them a little premium rate, which is your prime rate. They are not offered to all the customers, but like reserved for a specified customers basically. It is there to help the customers like do business with the bank more. Like supposedly, if I'm dealing with Kotak Bank and I'm a very good customer of their, a very old customer of their, so it's possible that on my supposedly on my overdraft facility, they don't charge the premium of the interest rate of 6% that they charge with everybody. Maybe they are taking 5.5% from me. So that additional 0.5% is the prime rate, which I'm getting benefit for. Moving forward. Okay, so bond rating. Bond rating basically it's an assessment that reflects the default risk of a firm's bonds as judged by the bond rating agency. So you all know the bond rating. You must have seen that A, double A, double B, triple B. So they are like the bond ratings that the bond that the rating agencies basically provide, which signifies how risky or how secured a bond is. So the higher the rating, the better it is. Liquidity premium. So the premium charged when a bond instrument cannot be converted to cash quickly at its existing value is the liquidity premium. So basically, if I want to sell maybe a marketable security, I'm trying to sell it just right now, and I'm in an urgent need of cash, but it's not readily converted to cash right now. So maybe I'll just like let go of a little bit more money just so that I can sell that security quickly. Is there any doubt anywhere, anybody? Korika, Hitesh, Naman? Sharon? Okay, let's just move on. That reflects with a
Hello.
long term.
Harshita,
Yes, ma'am.
your voice got cut. It's not coming. Now it's clear.
Can hear me?
I can hear you now, but it's not clear.
Ma'am, I think there is network.
Okay.
Ma'am, can you hear me now?
Yes.
Great. I switched to my data card right now. Okay, great. So the market premium is that premium which reflects the increased uncertainty associated with the long-term debt. So if I'm taking debt right now for say 10 years, 15 years, the lender doesn't know if my company will have a stable position for the next 15 years or not. So they can ask for a little higher price just to compensate for that uncertainty. Okay, so what is the term structure of interest rates? It is the relationship between nominal interest rate and time to maturity when default risk is held constant. Moving on. Okay, this is the yield curve which we are taking interest rate on y-axis and the time to maturity on x-axis. 6% is that risk-free return rate, which is like definitely it's gonna be there. So the curve will go upward from there on, depending upon how risky or how like the time period of your bonds. Okay, so senior debt, it's a debt which is secured by a ventures asset. So supposedly, if I want to take a debt of say 20 lakhs, maybe I'll secure or maybe I'll put a building as a collateral for the same. So that will become my senior debt. Subordinated debt, that's a debt with an inferior claim related to the senior debt to venture assets. Supposedly, I took another loan for say maybe 2-3 lakhs or 5 lakhs, and I gave another collateral, a smaller collateral in comparison to the building for the same. So that will come as subordinated debt. Investment risk of a loss, it is that probability, basically it is a probability loss from the venture investment. Okay, so expected rate of return, it is the probability weighted average of all the possible rates of return. So basically, if I'm like if I have a bracket of say 8 to 12% of rate of return, so by taking average of all of these fours, I can come up with the expected rate of return. Okay, so we are coming to standard deviation. That is the measure of the dispersion of possible outcomes around the expected return of the investment value. So basically, okay, do anybody know how to calculate standard deviation? Anyone? Porika, Hitesh, Naman, Banothu, Sharon? Okay, it's a simple statistical standard deviation that we calculate. It's easy. Okay, let's move on forward. So coefficient of variation, it is again the measure of dispersion risk per unit of the expected rate of return. Okay, so what are private equity investors? So basically, they are the like owners of the proprietorships or the partners in the proprietorship partnerships or the owners in closely held corporations. Closely held corporations are those corporations. Ma'am, can you move forward? Yeah, so closely held corporations are those corporations in which the stock is not publicly traded. So if Samriti ma'am and I have a company and uh, we are like holding a company together, but our stocks are not publicly traded in any of the stock exchanges or they are not publicly available to like purchase. So those are closely held corporations. Ma'am, can you move forward? So publicly traded stock investors, they are those equity investors of firm whose stocks trade in public markets, such as the over-the-counter markets or an organized securities exchange. So any company which is like being traded on maybe, I guess, BSE or NSE, right, ma'am?
Yes.
And so any company which is traded on that, that will be publicly traded stock investors. like Reliance or Tata Motors or any other company, any other listed company, basically. Okay. So let's move forward. So over-the-counter markets, they're a network of brokers and dealers that interacts electronically without having a formal location. So it's just like BSE, NSEs, and like these days, I think we are opening Demat account through which we trade the securities. So Demat account is just an electronic account, right? Anybody who trades in stock here? Banothu, Naman, Hitesh, Nitesh, Saran, any of you who actually trade in securities? No one? Okay. Let's move forward. So market capitalization or market cap, it's the firm's current stock price multiplied by the number of shares that are outstanding. Guys, there are a lot of definitions in this PPT, so please interrupt me anywhere where you do not understand them. So investment risk premium, that's the additional return that investors can expect to earn when investing in a risky publicly traded common stock. So basically, if I'm comparing two companies, I'm taking hypothetical companies like ABC Limited and XYZ Limited. And ABC Limited and XYZ Limited, they are of the same class, but ABC Limited is a risky investment. Like we don't know whether the stock will perform good or not in the next, like in the near future. So the investors, they will expect that if they are having a high risk quotient for the company, they will expect a high return as well. Only then I'll be able to willing to take high risk, right? So that's the investment risk premium. Moving forward. What is the market risk premium? It is the excess average annual return of common stocks over long-term government bonds. That is to say that the government bonds, they must be paying like 6% of interest. So the stockholders will expect to earn like maybe 7 or 8%. That is above the nominal rate of 6%. Okay. Okay, venture hubris. That is like optimism which is expressed in business plan projections that ignore the possibility of failure or underperformance. So basically, what happens that if supposedly Nitesh is starting up a new business of say manufacturing some new type of robots. Okay, he's starting that venture. So when he will be presenting his business plan and he'll be moving on with the projections that how much should he be able to earn in the first year, in the second year, in the third year, when he'll be thinking along all of those things, it is very common with the like startups that the entrepreneurs, they think that they will be earning a lot more than the actual market I think conditions. Okay, so that is the optimism with which they work. Like if I can see that the market rate is like the market rate of return is maybe like 20%, but as an entrepreneur I will feel that my product is the best in the market and I will take the market in a flourish and I should be able to earn like 25% rate, which is not possible, or which is not ideal for an entrepreneur to go with. So that optimism with the which the entrepreneurs express in their business plan projections, that is venture hubris. Okay, so this is the relationship between the venture's life cycle stage and the target rate of return. If you can recall the venture life cycle stage, we moved from development stage to startup stage to survival and rapid growth and then maturity. So as we can see that when we are in the development stage, our rate of return is more. That is seed financing. And as we move up to the early maturity rates, the rate of return keeps on decreasing. We move from startup financing to the first round financing, and then there's mezzanine financing. Okay, what is mezzanine financing? Anybody? Sharon, Nitesh, Hitesh, Naman, anybody? What is mezzanine financing?
I think it's basically for the startups that are expanding at a very high rate. So I think it's one of the first equity financing that they are getting.
No. So basically, Sharon, mezzanine financing, as I can recall, it's like a hybrid of debt and equity. So basically, you are like opening a startup firm, okay, and you like ask some money from me, okay, I'm your lender. You took some debt from me, but later on you could not return that debt to me. So you gave me an option to convert my debt of say 50 lakh rupees into equity. So
Okay.
earlier, while I was your debt holder, now I'm your equity holder. Samriddhi ma'am, am I explaining correct, right?
Yes, it's correct.
Yeah. Okay, great. So that's your Mas9 financing. That earlier I was your debt holder, but you could not repay me, so I converted it into the equity one. All right, Shan.
Right. Yes. Got it.
Great, perfect. Okay, so let's move forward. Okay, so this is the again the example that we have just covered, that while we were in development stage, so we were earning a higher rate of return, and then while we like climbed more stages of life cycle stage, the interest rate kept on decreasing. So the typical range is also given in this, and then we can move on forward. Ma'am, can you please move forward? Yeah. Okay, so weighted average cost of capital. All right. So weighted average cost of capital is the average of the cost of individual components of interest-bearing debt and common equity capital. So basically, for a company, there are like many sources of financing. Okay, so there is like earned earnings, there is equity capital, then there is preference shares, then there is debt. So each of these sources of finance, they contain a cost. When we take a weighted average of all these components, like base cost of debt, cost of equity, cost of preference share, and cost of retained earnings, then we get weighted average cost of capital. Can we move forward, ma'am? Okay, so we are done with it. Any doubt that anybody had during the entire PPT? A lot of like definitions were there. Any definition that you didn't understood? Any concept that was missing? Anyone? Sharon? Nitesh? Banotu? Okay. So I'm assuming there are no doubts. Let's move forward. Okay. Okay, so we can go with this material. I don't think that this is going to be tested, right, ma'am?
Yeah, it's not gonna be tested. Just like for the break-even analysis, this details about the types and cost of capital. In it basically discusses the cost of debt and preference shares and equity shares in detail. It won't be tested. It provides you knowledge on how to calculate it practically. That's it.
Okay, so let's move forward, or we can just quickly skim through the material if the class wants.
Should I move through it?
Let's just see what the class says. Sharon, should we move through the content more? Nitesh, yeah, Sharon, speak.
Yeah. Sure, ma'am. You could go ahead.
All right. Fine, so let's just skim through the material quickly just to show you guys. So the cost of debt, again, as I was explaining before, there are like different sources of finance for the company. The debt is again, like supposedly if the company is taking 50 lakh rupees of loan for say 8%, so that 8% will comprise as the cost of debt for the company. uh, then there is like tax advantage in the cost of debt, because the interest payments, if you remember the this what is it called? I'm forgetting. I'm so sorry. Okay, if you remember the cycle that we follow in income statement, so from the interest is deducted before paying tax, right? So the interest gives you a tax advantage. So that makes cost of debt generally cheaper than the other sources of finance. So you'll find that taking debt will be maybe cheaper than cost of equity or cost of preference shares or cost of retained earnings. We can move down, ma'am. Then there's cost of preference shares. Preference shares, I'm assuming that you all know what it is. Anybody who doesn't know what are preference shares, or should we recap on it? Hitesh, Naman, Sharon,
Yes, please, ma'am.
Nitesh. Okay. You want a recap on it, Nitesh?
Please, ma'am.
I'm sorry, I cannot hear you.
Yes, please, ma'am.
Okay, fine. Fine. Okay. So there are like two types of shares that we study, right? There are preference shares and then there are equity shares. So the preference shareholder, in the event of say liquidation, they will get money before the equity shareholders will get. Then at the time of dividend distribution also, first the profits are distributed in the preference shareholders. Then when the profits are left, then they are distributed in the equity shareholders. Okay, and the preference shareholders, they are given, I think, like their interest rate is also a bit higher. Like supposedly, if the equity shareholders are getting dividends of say 8%, they might be getting on 9% like that. Sorry, that the cost of preference shares, it's a bit higher. It's a bit than equity one. So we can go forward with that. And then there are the preference shareholders. They if they are not participating one, then they won't get a share in the profits, the remaining profits. Then I don't. Okay. Then they don't hold the power in the company that equity shareholders does. And then not audible.
Yeah, you were not audible.
In the last, that power part.
I was talking about the voting power. Basically, the equity shareholders, they have the voting power in the company, and the preference shareholders, they don't. Move forward. Still losing. Ma'am, is my voice still breaking?
Now you're audible. Now we can hear you clearly.
Okay, fine. So the cost of equity capital, again, we have discussed, like there are two types of like shares, that preference shares and equity shares. So the cost of equity is the cost that is borne by the company for the equity financing. Let's move forward on it. Okay, so out of all the costs that are cost of debt, cost of preference shares, and cost of equity and cost of retained earnings, the highest cost will be cost of equity. Then will come the cost of retained earnings, which will be just like slightly less than the cost of equity, because in cost of equity, flotation charge is there. Flotation charge is the cost that is borne by the company to raise the equity funds. ठीक है, तो जिसके अगर prospectus issue करा company ने, or like they are like calling for the raise of funds, so उसकी जो cost होती है, that is flotation charge. Cost of retained earnings के अंदर it won't be there, because that money is already there with the firm. Then will come the cost of preference shares, and the last will come the cost of debt, because in debt we get tax advantage. Also, our cost of preference shares and equity shares is higher, because we have to pay the dividend distribution tax, which is included in those costs. So those costs are also higher owing to that account. weighted average cost of capital, just like if we combine all of these four costs and like put a weighted like take a weighted average of these, you'll get the weighted average cost of capital, which is the cost basically which the company associates with all the projects. They're the examples which you can try. Okay, then they're just the examples that you can try. Fine. So we can go to the other material, I think, ma'am. So this material is like just for your knowledge basis. You can just go to it, go through the same to enhance your concepts. Okay.
Yeah, is it visible?
Yes, ma'am, it's visible. So this is the case. This is the research paper. So research in the field.
Harshita?
Yeah.
Yeah, your voice is cracking, I think, again.
Ma'am, can you take this one?
So it's just simply a paper which discusses about the sources of finance, and it won't be tested. It's only for your extra knowledge, and you can go through this material, and it basically consolidates all the researches that have taken place in entrepreneurial finance, and they discuss about various sources of finance that are available at different stages, and what costs they carry at different stages of a startup. So it won't be tested, but it's for your additional knowledge only. So that was it for today. Do you have any doubts? Hello? Hello?
Yeah. Yes, ma'am. Can you hear me?
Yeah, I can hear you, Harshita.
Great. Anyone has any doubts in the class? Karen, Hitesh, Naman.
Why equity shares cost more than preference shares? We just said.
See, okay, so let me just give you an example and let's see if you can understand it through that point. In the event of a liquidation, okay, when the company is closing down, preference shareholders, they will get the money earlier, like what will be the chain of the payments? Okay, first, like you will give your external debt. Okay, you will give them the money first. Then you will come to the shareholders, and in shareholders you will come to preference shareholders first, and then the equity shareholders. Okay, they will get the money in the last one. So if they are taking so much risk, and if they are ready to sacrifice all their earnings also in the event that the company is unable to pay them, then shouldn't their demand for return be higher than the preference shareholders one? If the preference shareholders are getting advantage over this factor that they are getting their money earlier than the the equity shareholders one, then shouldn't the equity shareholders get something extra?
Yes, ma'am.
So that is why, see, the cost of equity capital, it's the cost to the company, right? So the equity shareholders, they are more expensive than the preference shareholders to the company. Think of this cost for the company. As a company, you are calculating the cost of equity shares and cost of preference shares, cost of retained earnings. So cost of equity shares will be, of course, like higher than the other one, because they are the ones who will be handling all the risk later on. Equity shares holders are the one who will be paying you for everything that the company is doing right or wrong. They are the most invested in the company. Their risk coefficient is higher than the other ones. They are getting the returns in the end only. Getting it?
Yes, ma'am.
Wait, any other doubt? Samriddhi ma'am, please supplement if I'm missing anything.
Sure. Do you want us to go through any definition or concept again? Or do you want to attempt those numericals that we left? You can do it right now if you want.
Class, let's make it a discussion oriented classroom. So just speak if you need anything from us. If there are any previous doubts that you want us to clear, we have like half an hour more, so we can clear those doubts right now.
I have to attend some previous sessions before understanding all this.
Okay. Hitesh, you didn't attended the previous sessions, right? All right. Anybody else who's having any doubts or want to discuss something? Samriddhi ma'am,
Yes.
should we move to the numericals that were left?
Okay, we can discuss those numericals.
I don't think like anybody is left with any questions, right?
Hmm. Okay.
Can you take those numericals, please?
Uh,
I think third we completed. Now we have to go with fourth one.
okay, so guys, we'll move back to the numericals that we left. Okay, are you comfortable with that? At least someone should respond. Sharon,
Yes, ma'am.
should we go back to the numericals that we left? Do you want to attempt it on your own? Like you want to try it and then you can ask doubts? Or do you want uh, us to discuss it?
So please respond. Sharon, ma'am, is my voice breaking?
Yeah, you're not audible. Now we can hear you.
Sharon, can you please respond? Hitesh, Naman. Class, can you please respond whether we should continue with the numericals or some, ma'am?
Yes, Harshita?
To my
Your voice is breaking.
The connection.
Okay, someone should respond. Nitesh, Hitesh, Naman, Banutu, should I discuss those questions or will you attempt it on your own? Like attempt it right now so you can ask your doubts if you have any. Hello.
Class, are we
Yes, ma'am.
audible right now?
Yes, ma'am, we are audible.
Great.
So Nitesh, do you want to attempt questions on your own or should we discuss them, the ones which we left?
Actually, I need some time to solve them. I just said.
Okay, okay.
All right, class. So that's it for today. Let's close the session here. And if anyone has any doubts and any queries that you want us to address, please ask now. The numericals that are left, please go and attempt it back home. And if you cannot understand anything, please let us know. We are there to help you, but you need to be more expressive, guys. Please. Anyone wants to ask anything? Bantu, Naman, Hitesh, Sharon, Nitesh.
No.
Should we close the session? Class, please respond. Should we close the session?
Yeah, ma'am, you can.
Okay, great. Please go back to the material, the material that is covered in the class and the one which is available for your deeper understanding. Please go through them. In case of any doubts, please feel free to reach out to us. Samriti ma'am, should we close here?
Yeah. Naman, do you have to say something?
No, ma'am.
Okay.
I
Yeah.
couldn't hear his response. Did he said anything?
No, he just said no.
Oh, okay. I'm audible, right, ma'am?
Yes, you're audible.
Okay, great. All right, class. So we'll close it here. See you on Friday at the same time.
Thank you.